January 23rd, 2026, a date that will be written in the obituary of the global financial system. At 9:47 a.m. Eastern Time, something broke. Not a machine, not a market, but a 50-year lie. Silver pierced 99.16 in New York, while Shanghai already sat at $111.66, a $12 gap between two exchanges trading the same metal at the same moment. The banksters, the ones who've controlled this market since the 1980s, are now staring at their screens, watching mathematical insolvency materialize in real time. Their short positions, trillions in exposure, are now bleeding at a rate of billions per hour. But here's what they're not telling you. Welcome to your John A. Joe. You've just witnessed the opening move of the largest financial upheaval in modern history. And if you're a business owner, an entrepreneur, or someone who understands that markets don't break, they're broken, then you're in exactly the right place. Now, I want you to do something for me. If you've lived through enough market cycles to know that when banks panic, regular people pay the price. If you remember when they told you gold was a barbarous relic, when they said real estate never falls, when they promised your pension was safe, then hit that subscribe button right now, because what's coming next isn't theory, it's mathematics. And before we dive deep into the systemic collapse that's unfolding, tell me in the comments, where are you watching this from? Are you in New York, watching the same institutions that are collapsing? Are you in Asia, where the smart money has already moved? Or are you somewhere in between, trying to figure out what this means for your business, your savings, your future? Drop your location below, because what happens next depends on where you're standing when the dominoes fall. Now, let's talk about what really happened on January 23rd. Friday, January 23rd, 2026. Began like any other trading day. Coffee machines hummed in trading floors across Manhattan, screens flickered with pre-market data, and silver sat quietly at $97.80 per ounce. But by 9:47 a.m. Eastern Time, everything changed. The number that flashed across the Globex terminal was one that traders had been told would never appear, 99/16. For 48 hours, the price had been climbing steadily, relentlessly. Every attempt to push it back down failed. The banks had tried everything. At $95, they dumped paper contracts into the market, thousands of them, hoping to create a wall of selling pressure. The market absorbed them and kept climbing. At $98, they raised margin requirements, forcing smaller traders to liquidate their positions. The price dipped for 17 minutes, then surged higher. And now, at $99.16, the psychological barrier that had held for decades was gone. But this number, as shocking as it was to Western traders, was already old news. Because while New York was cautiously testing triple digits, Shanghai had already kicked the door down. The Shanghai Gold Exchange, the largest physical precious metals market in the world, had closed its Friday session hours earlier. The closing price for silver, $111.66 per ounce in local terms, 24,997 yuan per kilogram, an 8.5% gain in a single session. This wasn't a normal price movement, this was a market dislocation. A $12 premium between two exchanges trading the same commodity on the same day. In traditional markets, such gaps don't exist. Arbitrage traders, with their algorithms and instant execution systems, close these spreads within seconds. Buy the cheaper market, sell the expensive one, pocket the difference, risk-free profit. But this gap wasn't closing, it was widening, because something fundamental had broken in the system. The Western banks, the ones who had controlled silver prices through derivative contracts and paper trading for decades, had finally lost control. Their defense strategy had been simple. When physical demand increased, they didn't sell physical silver. They sold promises, paper contracts, traded on the COMEX exchange, that represented silver that didn't exist in any vault. For years, this worked perfectly. When the price approached levels they didn't like, they simply issued more contracts. The market would see the increased supply, and the price would fall. But January 23rd was different. The physical buyers in Shanghai weren't interested in paper promises. They wanted metal, real silver, that could be weighed, touched, stored, and shipped. And they were willing to pay $111.66 to get it. Meanwhile, in New York, the short sellers were doing the mathematics. At $95, their positions were uncomfortable. At $98, their positions were dangerous. At $99, their positions were catastrophic. Every dollar the price climbed represented billions in losses, not paper losses that could be hidden in quarterly reports, real losses that triggered margin calls, that required immediate capital, that threatened the solvency of the firms themselves. The trading desks at the major banks were no longer calm. Analysts were running stress tests, calculating exposure, modeling worst-case scenarios. Risk managers were on emergency calls with senior leadership because the mathematics were simple and terrifying. If silver reached $105, certain counterparties would default. If it reached $110, certain derivative chains would collapse. If it reached $120, certain banks would face insolvency. And Shanghai was already at 111.66 GARs. The gap between the two markets, the $12 premium, was now a tractor beam. Every arbitrage algorithm in the global financial system was screaming the same instruction. Buy New York, sell Shanghai, capture the spread. 12% profit, instantly, risk-free. But there was a problem. To capture that profit, traders needed physical silver. Not contracts, not derivatives, not promises. Physical metal that could be shipped to China, and there wasn't enough available. The COMEX warehouses, which supposedly backed all those paper contracts, held only a fraction of the metal that had been sold. The refineries were already running at capacity. The shipping containers were already booked. And the Chinese buyers weren't slowing down. They were accelerating. By the closing bell in New York, silver had settled at $98.73, slightly below the intraday high, but still firmly above the psychological barrier. The banksters had managed to push it back below $99, barely. But everyone watching the market knew the truth. The dam had cracked, and the pressure behind it was building. Shanghai would open again in 12 hours, and when it did, the real chaos would begin. The manipulation didn't begin in 2026. It didn't even begin in this century. To understand what broke on January 23rd, one must go back to a different era entirely. March 1980. Silver hit $49.45 per ounce. The Hunt brothers, two Texas oil billionaires, had attempted to corner the global silver market. They bought physical metal. They bought futures contracts. They bought everything they could find. And the price exploded. Panic swept through Wall Street, not because silver was expensive, but because the Hunt brothers had exposed a vulnerability in the system. They had proven that physical demand, if concentrated enough, could overwhelm the paper market. The exchanges changed the rules overnight. They raised margins. They limited positions. They restricted trading. The Hunt brothers were forced to liquidate, and silver collapsed back to $10. But the lesson was learned. Never again would the banks allow physical buyers to control the price. They needed a new system. A system where they controlled supply without ever touching physical metal. The solution was elegant and completely legal. Derivatives, by the mid-1980s, the COMEX futures market had become the primary mechanism for price discovery. Not the physical market, where actual metal changed hands. The paper market, where contracts were traded, settled in cash, and rarely resulted in delivery. The leverage was extraordinary. A single ounce of physical silver could back 100 ounces of paper contracts, sometimes more. The banks became market makers, writing contracts on both sides of every trade. They collected fees, they managed risk, and most importantly, they controlled the price. When too many buyers appeared, they simply issued more contracts. The supply was infinite, because it was imaginary. For decades, this system functioned flawlessly. In 2011, silver rallied to $48, approaching the 1980 high. The banks deployed the same playbook. Margin requirements were raised 5 times in 8 days. Small speculators were forced out. The price collapsed to $26 within weeks. In 2020, during the pandemic, silver surged to $29. Physical demand was overwhelming. Retail buyers were emptying coin shops. Premiums were spiking, but the paper price barely moved. The COMEX issued more contracts, and the rally was contained. In 2023, the Reddit community attempted a coordinated silver squeeze. They called it Banksters silver squeeze. They bought physical metal. They bought shares of silver miners. They tried to force delivery on COMEX contracts. The price jumped from $25 to $30, then stalled. The banks had learned from GameStop. They limited retail access. They tightened lending. They coordinated with brokers to prevent another short squeeze. The pattern was consistent. Every time physical demand threatened to overwhelm the system, the paper market absorbed the pressure. Every time the price approached dangerous levels, new contracts appeared. Every time delivery demands increased, cash settlements were negotiated. The regulators, the CFTC, the bodies responsible for preventing manipulation, were remarkably absent. Reports of concentrated short positions, held by just 2 or 3 banks, were acknowledged but never addressed. Investigations were opened and quietly closed. Fines were occasionally issued. Small amounts, costs of doing business. The banks paid them and continued operating because the truth was uncomfortable. The entire modern financial system depended on this manipulation. Silver wasn't just a commodity, it was a competitor to fiat currency. If silver's true value were revealed, if it rose to reflect actual supply and demand, it would expose the devaluation of every paper currency on Earth. Central banks, who had been printing money for decades, couldn't allow that. Commercial banks, who profited from the dollar's dominance, couldn't allow that. Governments, who financed deficits through currency creation, couldn't allow that. So the system continued, year after year, decade after decade. The price remained suppressed, disconnected from fundamentals. Industrial demand increased, mine supply decreased. Above-ground inventories fell, but the paper price stayed range-bound between $15 and $30 for 20 years. A narrow channel, maintained through constant intervention, but every system has limits. Every dam, no matter how well constructed, can only hold so much pressure. By 2025, cracks were appearing, physical premiums were rising, delivery delays were extending, vault inventories were falling, the gap between paper and physical was widening. And then, something changed. The buyers in Shanghai stopped playing by Western rules. They stopped accepting paper settlements. They stopped trusting COMEX inventories. They demanded physical delivery, paid premiums, and absorbed everything available. The Chinese government, understanding the strategic value of hard assets, encouraged this accumulation. State-owned enterprises, sovereign wealth funds, even individual citizens were buying silver, not as speculation, as insurance against Western currency collapse. By January 2026, the Shanghai Gold Exchange was trading more physical silver than the COMEX. The price discovery mechanism had shifted. The East was setting prices, and the West was following. The banks, who had controlled this market for 40 years, were now reacting to forces beyond their control. Their paper contracts, their margin manipulation, their regulatory capture, none of it mattered anymore. Because the Chinese buyers weren't in their jurisdiction, weren't using their exchanges, weren't subject to their rules. The architecture of deception, built so carefully over decades, was collapsing. Not because it was illegal, but because it was obsolete. There's a principle in physics called gravitational equilibrium. When two celestial bodies exist in proximity with different masses, the smaller body is pulled toward the larger one. Not immediately, not violently, but inevitably. The force is constant, relentless, and cannot be negotiated with. On January 23, 2026, the global silver market discovered it was subject to the same law. Shanghai, at $111.66, had become the gravitational center. New York, at 99.16, was being pulled upward, whether it wanted to be or not. The mechanism driving this force wasn't emotional, it wasn't speculation, it wasn't fear, it wasn't greed, it was pure mathematics. And mathematics, unlike humans, cannot be manipulated. The calculation was simple enough for a first-year finance student. Buy silver in New York at $99, sell it in Shanghai at $111, profit $12 per ounce, 12% return, instantaneous, guaranteed. In the trading world, this is called arbitrage, and arbitrage opportunities in efficient markets exist for milliseconds before algorithms close them. But this opportunity wasn't closing, it was expanding. By Friday afternoon, the spread had widened to $12.50. By Monday morning in Asia, it reached $14. The algorithms were screaming, but they couldn't execute. Because this wasn't a digital arbitrage, this was physical. To capture the profit, traders needed to move actual metal across oceans, through customs, into Chinese vaults. The process took weeks, not milliseconds, and every step required something that was rapidly disappearing. Available silver, the COMEX warehouse stocks, which theoretically backed the paper contracts, told a disturbing story. Registered inventory, metal available for delivery, stood at 47 million ounces on January 1st. By January 23rd, it had fallen to 31 million ounces. 16 million ounces had vanished in 3 weeks. Not sold, not transferred, delivered. Physical metal loaded onto trucks, shipped to refineries, recast into kilobars, and sent to Asia. The eligible inventory, metal stored but not available for delivery, was larger, but that number was meaningless because eligible didn't mean accessible. Much of it belonged to industrial users, jewelry manufacturers, electronics companies. They weren't selling, they were holding, watching the price rise, calculating their own exposure. The refineries were running triple shifts. COMEX bars, 1,000-ounce bricks, were being melted down and recast into kilobars, the format preferred by Chinese buyers. The refining capacity, normally sufficient, was now the bottleneck, 4 to 6 weeks, for new orders. The shipping companies were facing similar constraints: secure transport, insured containers, armed escort. These things couldn't be arranged overnight. And even when metal reached the ports, another problem emerged: export restrictions. The United States government, watching strategic reserves drain eastward, was considering intervention. Nothing official, nothing announced, but permits were being delayed, inspections were being scheduled, paperwork was being questioned. The flow was slowing, but it wasn't stopping, because the profit was too large to ignore. Family offices, the private wealth managers for billionaire dynasties, were mobilizing capital. They saw what was happening. They understood that this wasn't a trade. It was a transfer of wealth, from west to east, from paper to physical, from illusion to reality. One family office in Geneva, managing $4 billion, allocated 15% to physical silver in a single week, not through ETFs, not through mining stocks, physical metal, stored in Switzerland, available for delivery to Shanghai if the premium persisted. Hedge funds were more aggressive. They were buying call options, futures contracts, anything with leverage. Not because they believed in silver's long-term value, because they smelled blood. The short sellers, the banks who had suppressed this market for decades, were trapped. And when a predator is trapped, other predators circle. The sovereign wealth funds move differently. Norway's government pension fund, managing $1.7 trillion, had historically avoided commodities. In January 2026, they purchased $200 million in physical silver, a small position for a fund that size, but symbolic. State capital, government money, was now betting against the banks. Qatar's sovereign fund followed, then Abu Dhabi, then Singapore. These weren't speculators. These were institutions with 50-year time horizons, managing generational wealth, making strategic allocations. They were reading the same data everyone else was seeing. Mine production, falling for the third consecutive year. Industrial demand, rising as solar panels and electric vehicles consumed more silver. Investment demand, exploding as inflation eroded confidence in paper assets. And above-ground inventory, the buffer that had always prevented shortages, was disappearing. The U.S. Geological Survey estimated global above-ground silver stocks at 2.8 billion ounces. But that number was meaningless. Most of it was already allocated. Jewelry, silverware, industrial products, religious artifacts, the amount available for investment, for industrial use, for delivery against contracts, was a fraction of that total. Perhaps 500 million ounces, perhaps less. No one knew the exact number, because no one tracked it. And now, with Shanghai demanding delivery, with arbitrage traders scrambling for metal, with sovereign funds building strategic reserves, that buffer was evaporating. The COMEX had 31 million ounces registered. The Shanghai Gold Exchange had standing delivery requests for 85 million ounces. The mathematics were simple. There wasn't enough metal to satisfy demand at current prices, which meant prices had to rise, not to $110, not to $120, but to whatever level destroyed enough demand to match available supply. The algorithms knew this. The family offices knew this. The sovereign funds knew this. And the banks, watching their short positions bleed billions per day, knew this too. They had three options: cover their shorts, buying metal at rising prices and accepting catastrophic losses, default on delivery, triggering legal action, and destroying their credibility, or convince governments to intervene, changing rules, suspending markets, protecting the system. The first option meant bankruptcy. The second option meant criminal investigations. The third option meant admitting, publicly, that the free market was a lie. On January 23rd, as Shanghai closed at $111.66 and New York struggled to hold $99, the banks were running out of time to choose, and the mathematics, indifferent to their preferences, continued calculating their doom. There's a moment in every financial crisis when numbers stop being abstract, when spreadsheets transform into survival calculations, when the executives stop discussing strategy and start discussing lifeboats. For the major banks holding short positions in silver, that moment arrived at 2:47 p.m. Eastern Time on January 23, 2026. The price had just touched $90.16. And in the risk management departments of three major financial institutions, alarm systems began flashing red. Not metaphorically, literally, automated risk protocols, designed to warn executives when exposure exceeded safe thresholds, were triggering. Because at $90 per ounce, the mathematics of insolvency became unavoidable. The largest short position belonged to a bank that cannot be named for legal reasons, but the position can be quantified. Approximately 240 million ounces held short through futures contracts and over-the-counter derivatives. At $80 per ounce, this position was uncomfortable but manageable. The mark-to-market loss was $4.8 billion. Large, but absorbable for a bank with $50 billion in Tier 1 capital. At $90 per ounce, The loss expanded to $7.2 billion, still survivable, though questions were being asked by board members. At $19.99 per ounce, the loss reached $9.36 billion. And here, the mathematics changed, because this wasn't the only risk on the balance sheet. The bank also held exposure to commercial real estate, which was collapsing. It held exposure to regional banks, which were failing. It held exposure to sovereign debt, which was being downgraded. Total capital adequacy, the buffer between solvency and failure, was eroding from multiple directions. The silver position, which had always been considered manageable, was now the accelerant. Risk managers ran the scenarios. At $105, total losses reach $11.4 billion. Capital adequacy falls below regulatory minimums. At $110, losses reach $13.2 billion. Counterparty defaults begin cascading. At $120, losses reach $16.8 billion. The bank requires emergency capital injection or faces insolvency. These weren't hypothetical projections. These were mathematical certainties. Every dollar silver rose cost the bank $240 million in real losses. And Shanghai was already at 111.66. The second largest short position, held by a different institution, was smaller in size but more leveraged. Roughly 150 million ounces, but backed by less capital. This bank had used silver derivatives as collateral for other trades, a practice called rehypothecation, the same silver position, pledged multiple times, to secure different obligations. At $80 silver, the collateral was sufficient. At $99 silver, the collateral was impaired. If silver reached $105, the collateral would be insufficient, and margin calls would be issued on the other trades, not just for silver, but for everything the collateral backed. Bond positions, currency swaps, interest rate derivatives, a cascade. One failure, triggering another. The third major institution faced a different problem. Its short position was smaller, only 80 million ounces, but it had sold insurance in the form of options to other traders, specifically put options, contracts that paid out if silver fell below certain levels. At $80 silver, these options were profitable. The buyers were paying premiums, and the options were expiring worthless. But at $99 silver, these options had become liabilities, because the bank had also sold call options, betting silver wouldn't rise above $95, a strategy called a strangle, profitable in range-bound markets, catastrophic in trending markets, and silver was trending violently. Every dollar above $95, the bank owed money to call option holders. Every dollar below $95, the bank owed money to put option holders. At $99, both sides of the trade were losing simultaneously. The options desk, which had generated steady fee income for years, was now hemorrhaging capital. And the counterparties holding these options knew it. They could see the bank's exposure. They could calculate the losses. And they were doing what predators do when they smell weakness. They were attacking. Hedge funds were buying more call options, forcing the bank to hedge by buying futures, which drove the price higher, which increased the value of the calls, which required more hedging. A feedback loop. The bank was trapped in a position where its own hedging activity was making its losses worse. This is called a gamma squeeze, and it's how institutional traders bankrupt each other. The strategy was being coordinated, not illegally, not through collusion, but through open information. Every major hedge fund could see the bank's positions through regulatory filings. They could estimate exposure, calculate breaking points, and structure trades accordingly. One London-based fund, managing $8 billion, had allocated $400 million specifically to exploit bank weakness. They were buying physical silver, buying call options, and spreading information through trading networks. Not rumors, facts. Facts about warehouse inventory depletion, facts about Shanghai premiums, facts about refinery bottlenecks, every fact. Designed to increase buying pressure and accelerate the bank's collapse. This wasn't personal, it was business. In finance, killing a competitor legally is called alpha generation, and the alpha in this trade was extraordinary. The fund had entered positions when silver was at $92. At $98, they were up 7.6%. If silver reached $110, they'd be up 19.5%. If the banks defaulted and silver spiked to $150, the returns would exceed 60%. Risk adjusted, accounting for the probability of each outcome, the expected return was still above 30%. These were venture capital returns on a liquid commodity trade with limited downside. The fund managers weren't hoping for bank insolvency. They were calculating its probability and betting accordingly. Other institutions were joining. A Singaporean sovereign fund quietly accumulated $600 million in silver miners, not for the dividend yield, for the leverage to silver prices. If silver doubled, the miners would triple or quadruple. A pension fund in Texas, managing retirement accounts for 200,000 teachers, shifted 3% of assets into physical precious metals, a violation of their traditional allocation strategy, but justified by fiduciary duty. If currency collapse occurred and silver was the only performing asset, they'd be protected. If silver crashed, they'd lose 3%, asymmetric risk. The mathematical logic was spreading through institutional finance, not as panic, but as rational calculation. The banks were cornered. The evidence was public. The opportunity was clear, and capital, always rational, always seeking maximum risk-adjusted returns, was flowing toward the kill. By the close of trading on January 23rd, the pressure was mounting from every direction. Physical buyers in Shanghai, demanding delivery, arbitrage traders, draining COMEX inventories, hedge funds, squeezing short positions, sovereign funds, building strategic reserves, and the banks trapped in positions they couldn't cover, watching their capital erode in real time. The Federal Reserve had been briefed. The Treasury Department was monitoring. The CFTC was in emergency meetings, because everyone understood what came next. If the banks defaulted on silver contracts, the contagion would spread. Counterparties would fail. Derivative chains would collapse. Credit markets would freeze, not because silver mattered to the economy, but because trust mattered. And if contracts weren't honored, if delivery obligations were suspended, if rules were changed mid-game, trust would evaporate. The system, built on confidence, would fracture. And no amount of liquidity injection, no emergency lending facility, no regulatory intervention could repair what broke when trust died. The banks knew this, the regulators knew this, the government knew this, and the predators circling the wounded institutions knew this too. They were betting that the system would choose the banks over the market, that rules would change, that contracts would be voided, that silver would be declared a national security issue, and trading would be suspended. Because if that happened, and physical silver became unavailable through legal channels, the premium would explode, the black market would emerge, and the real chaos would begin. On January 23rd, as trading desks went dark and executives headed home, everyone was running the same calculation. Not whether the system would break, but when, and whether they'd be positioned correctly when it did.